Thanks everybody for coming today. It's great to see everybody here. So good afternoon. My name is Sean Campbell. I'm the chief economist at the Financial Services Forum. We just finished hearing about innovation inside the banking sector, so now I want to turn your attention to the non-bank financial sector for just a little bit. As I'm sure we're all aware, non-banks continue to represent a larger and larger presence in the US and the global financial system. According to one measure of non-bank financial activity published by the Financial Stability Board, global assets held by non-bank financial intermediaries has grown from roughly $18 trillion in 2003 to about $68 trillion in 2021. Whether one thinks of the recent rise of newer financial structures, such as stablecoins, or simply the increasing presence of non-banks in the arena of good old-fashioned lending, the increasing presence of non-bank players in our financial system is pretty plain to see. The goal of today's panel is to talk about how non-banks are influencing the overall risk profile of the financial system, as well as the changes this development presents for the regulation and oversight of the entire financial system, banks, non-banks, and everything in between. More specifically, how are risks migrating through the financial system, and what effects might it be having on the economy and financial stability? And how do we then assess the regulation and supervision of non-banks in that context? So today we're really lucky, and I feel really privileged to have the opportunity to speak with three significant experts in this particular field. So let me introduce each one of them very quickly, and then we can get into the discussion. So here to my immediate right is Hilary Allen. Hilary is a professor of law and the Associate Dean for Scholarship at the American University Washington College of Law. Professor Allen is an internationally recognized expert on financial stability regulation and new financial technologies. She's the author of the book, Driverless Finance, FinTech's Impact on Financial Stability, as well as many academic articles in the field. Next to Hilary is Dick Berner. Dick is currently a professor at the Stern School at NYU, and before that he was the director of the Office of Financial Research during the Obama administration. So Dick has a really great perspective, both as an academic and as a policymaker as well, which I think will be great for the panel. Dick has written widely on the issue of non-banks and has deep policy expertise in the area, given his previous roles at the OFR and the FSOC. Finally, to the extreme right of the stage, or at least to my extreme right, Karen Petro. So Karen is co-founder and managing partner of Federal Financial Analytics, which provides advisory services on legislative, regulatory, and public policy issues affecting financial services companies. Karen has written extensively on the financial sector and continues to be an active contributor to the policy debate on bank capital regulation, as well as the development of the non-bank sector. In particular, just last week, Karen testified before Congress, expressly focusing on risks resulting from financial service migration beyond the regulatory perimeter, so well-timed for today's discussion. So with that, we're going to dive into the discussion. And just one other thing I guess I would say, in light of the discussion that we had today from Secretary Raimondo and from the previous panel, I think there are a lot of really great points raised in both of those contexts and both of those discussions that we can hopefully kind of fold into today's discussion a little bit, as that becomes appropriate. Issues regarding obviously technology, and some of the other things that we talked about with respect to innovation. So I think this panel will be a good opportunity to try and reflect on some of the points that were made earlier in the day. So I just kind of want to open things up at a high level by kind of asking each of our panelists to reflect on kind of an opening question to kind of set the stage for the rest of the conversation, if you will. So, and I'm just going to ask each of the panelists kind of going down the line to give their thoughts on this kind of beginning opening question, and then we can kind of take things from there. So given the changes that we've seen to the financial system in the past decade, thinking broadly about how you think the financial sector has evolved over the past decade, how would you characterize the relative balance between bank and non-bank financial institutions? And in particular, are there any specific or recent developments that you think are particularly noteworthy for thinking about this balance between bank and non-bank financial institutions? So Hilary, if you wouldn't mind kicking us off, and then we can just go right down the line.
So keeping with the theme of today, I think the development that's particularly noteworthy is the role of technology companies in delivering financial services and what that's doing to the balance between banking and non-banking firms. And there's a lot you could talk about here. You could talk about how giant tech platforms are increasingly seeking to provide financial services, and whether this is creating a scenario where these tech giants could end up being too big to fail financial institutions that would be candidates for government bailouts. I think China has already had to grapple with this, with the rise of Alibaba, et cetera, in China. So, I mean, that's something to think about. I think in the United States, the concept of keeping banking and commerce separate is familiar, even though it's not always fully enforced. But it's really only the deposit-taking part of that is kept separate from commerce. So what the rise of these tech platforms prompts us to think about is, do we need a broader separation of other bank functions like payments or credit from commerce? Or whether banking law is the wrong direction to tack this from. Is this really an antitrust problem rather than banking regulation or other financial regulation? Turning to sort of another angle on tech and finance, I personally have been doing a lot of work on the operational risks posed by third-party service providers, technology providers to banks. And we've heard a lot today about this maxim, same activity, same risk, same rules. I think that often makes sense, but it really tends to break down when you're talking about operational risks, because there the risks are precisely tailored to the technology that you are using. So really, it may be the same functional activity, but your operational risks are going to vary depending on what kind of tech and what kind of provider you're going to use. And I suspect that everybody thought of the cloud when I said that, but it's not just the cloud. I think we also should be thinking about things like APIs, these application programming interfaces that allow different systems to speak to one another, essentially creating some level of interoperability. You know, these APIs have generally proven to be a cybersecurity target, and then also they are good at communicating problems. So if you have a cyber attack on a bank that uses an API to link to another non-bank provider, which then links to other banks, you know, is that going to be a conduit through which problems flow? You need to think about that when you're thinking about operational risk.
Okay, thanks. That's really great. Dick, over to you.
Thanks, Sean. Thanks for the opportunity, particularly the opportunity to be on this panel with these two amazing women. What Sean didn't mention in the intro was that I also spent 30 years in the financial services industry as well, and saw the growth of technology. And Hillary pretty much covered the waterfront on that score. But you know, the use of technology in banking and financial services goes back a long way, since the invention of computers, and watched that and watched how it proliferated. Equally, there's innovation that's been prevalent in financial services that has, used technology as an enabler, but has evolved as we've changed our regulatory structure. So the growth of securitization, the growth of our capital markets, all those things that have contributed to that are well known to all of you. But I think it's also worth mentioning the fact that, with that has come the growth of institutions that represent other kinds of opportunities and other kinds of risks. So securitization has enabled us to establish open-end credit and bond funds that promise short-term redemption, but which have maturity transformation, liquidity transformation as some of the risks involved. And those are things that people are starting to pay attention to in what we've seen. I think a second has been, effectively the death of unsecured finance. The growth of collateralized finance in our system, both here and around the world, I think is an important factor that mutualizes counterparty risk, but substitutes for it, or maybe some would say transforms it, into liquidity risk. So I think about liquidity risk a lot, and I'm doing a lot of work on that. I serve also as a member of the Market Risk Advisory Committee at CFTC, and those issues are at the forefront there. Third issue is related to that. The mandates for central clearing of derivatives, and now the prospect of central clearing for our treasury market, the deepest and most liquid in the world. And are we thinking carefully about the risks in that activity? That is, the activities involved in our payment system. I know we're going to talk about that a little bit later, but those are absolutely critical to the functioning of the financial system, and they involve operational risks, as Hillary alluded to, and I think we need to think harder about those things and the liquidity risks that result from that. So those are three areas, I think, of risk, and I know we're going to talk more about this, but really important developments.
Karen, please.
Thank you, Hillary and Dick. You've said a lot of really important forward-looking things, but I think I'll look backwards, because when I think about bank and non-bank competition, I think about what's the business of banking, and where has it gone? And yes, insured deposit taking is now still only within banks, but regulatory arbitrage in the role of non-banks goes back to 1980, when their Reg Q set interest rate ceilings, and I wouldn't say God, but Fidelity and Dreyfus created the money market fund, allowing save small amounts of funds to circumvent the deposit system to escape what was then, in an inflationary era, an idiotic regulatory set interest rate. And the banking industries never got those funds back. As soon as rates go up, money flees. When in flights to safety, it comes back. But it's just the classic arbitrage, where you look at one side of the business of banking, deposit taking. We didn't even think about it anymore, but it's dramatically changed by virtue of nothing but regulatory arbitrage. And I think the technological readiness, such as it was in 1980, of competitors to take quick advantage of the inability of banks to adapt to external circumstances. And you look at other core markets, you look at mortgages, again, bread and butter banking, somewhere between, depending on what kind of mortgage finance you look at that isn't portfolio lending, 70 to 90% of that has gone out of the banking system into non-banks. Small dollar installment lending, 35% is now fintech. And then you look, for example, at private credit, a business growing very, very fast. I saw the other day that Apollo projects, I think, hopes that their private credit business will be a $40 trillion sector, redefining the fixed rate market, the floating rate market in 5 years. And banks are already, JP Morgan, Jamie Dimon says, well, if large corporate lending goes to private credit, we'll serve that market. In other words, we'll cling to it with our fingernails. We'll use our infrastructure, we'll use our technology, but that risk intermediation function has gone elsewhere. And it's happening core sector by core sector, arbitrage by arbitrage. And finally, Sean, I would say that your numbers from the Financial Stability Board about the trillions in non-banks are important. But I looked yesterday preparing for this panel, and I found some Fed data which really, non-bank financial assets now are have 3 times the macroeconomic impact of that now held in the depository banking system. You can measure that in different ways, but from a macroeconomic and financial stability perspective, based on just the raw numbers, non-banks have 3 times the clout. And that's really different. And it's just kind of keeps happening. Started with money market funds, and now we're talking about AI and Amazon, and all these are vital issues. But bit by bit, it's changing the basic business of banking and the model as a whole.
Okay, thanks very much. So Karen, I want to stay with you for just a minute to pick up on a regulatory-related issue, and actually, it's at least tangentially related to something that Hillary talked about a second ago. So in her remarks, she was talking a little bit about this traditional separation of banking and commerce, which we think very much as being a regulatory issue, which is related to banks. And Hillary made the I think kind of interesting and important point that maybe we need to think more broadly about that. Where does the payment system fit into that? Where does, say, Amazon fit into that? That's a really interesting question. So I want to go back for a second, Karen, with you to talk a little bit about merger policy. So, merger policy is something that gets focused on quite a lot in the banking sphere. Not to say that it's not focused on in other spheres. There's a sort of a governmental lens on merger policy kind of across various sectors of the economy. But certainly in banking, there's been a focus on merger policy for quite a while, last 10 or 15 years. After the Dodd-Frank Act, they sort of changed the requirements. So now whenever there's a bank merger, there has to be a financial stability analysis that gets done along with that, along with that merger analysis, which is kind of a new requirement, kind of following the fallout from the financial crisis. So I just wonder, how do you think about sort of merger policy in the context of the non-bank space, and how would you relate it to sort of what we see in the bank space?
I think, and Hillary, you raised the important point, particularly in areas of operational risk. where you see tremendous amount of consolidation and the role of non-banks based by acquisition, in particular buying small competitors, or sometimes not so small competitors. And we recently did a lot of work on one major acquisition, that of Intercontinental Exchange of Black Knight, another large a large mortgage software processor. ICE is a phenomenal company when you start to open the lid. It's systemically designated in both the US and UK by virtue of its credit default swaps, and it's a financial market utility. A concept I think we need to spend a lot more time on than we have. We've been so focused with non-bank SIFI designations, and the insurance companies and the asset managers are fraught with the new discussion of what FSOC is going to come out, but we've lost sight of this critical issue of operational consolidation in the core financial infrastructure and the risk that that poses. And that's exactly what happened when the ICE deal came before the Federal Trade Commission. The idea, what systemic risk? They really didn't understand it. It's not something the FTC thinks about. But here you have an entity, ICE, being the dominant provider of loan origination software, pricing software, a variety of other, even consumer-facing software, setting the terms, conditions, and the offerings of mortgages across the country by virtue of its huge stake across the entire sector, now linked to an entity owning the New York Stock Exchange with its operational glitches, the credit default swaps with the risks inherent in that, and the risk of migration from one financial sector to the other by virtue of all of these platforms completely not understood and largely undesignated, and as of a couple of weeks ago, allowed by the Federal Trade Commission. So I really think with everybody hopping up and down about big bank mergers and consolidation and too big to fail, we took our eye off the risk on the other side, and because it's an operational financial market infrastructure one, that's a really dangerous thing to overlook.
Dick and Hillary, I wonder if you have any thoughts on that.
I do. Actually, obviously, as Karen was alluding to, technology has contributed to huge scale economies, and that's been true in financial services forever. And one question that we ought to think about when we think about companies that are merging is, do the people who work in these companies have the capacity to understand both the financial risks and the operational risks? The technology savvy, much as we saw a fantastic panel here before, in many financial services companies, other than the large institutions who are represented on that panel, maybe not be up to the task. And when we think about the interconnectedness of even mid-sized financial institutions with their third-party providers of technology services, do they have the capacity to understand what those risks look like? Because just as the system is interconnected from a financial perspective, it may be even more interconnected from an operational risk and cybersecurity perspective. So that's one thing to think about. I think the other, from a financial stability point of view, is, we can have financial stability issues that arise from people who are in the same activity, even though they may not be large and consequential, like the SIFIs or like the designated financial market utilities. But when we add their risk up together, if they are interconnected and they're on the same side of a trade, then that might add to financial stability considerations as well. And we focus a lot on those things, but honestly, I don't think we're ready to grapple, or we don't have the tools yet to think about how to grapple with those. The last thing I would mention is that, and Karen alluded to this a little bit, but let's face it, in the United States, we have a rather fragmented regulatory structure for financial services. And I don't think, and many people have opined on this, it serves us as well as it possibly could. That doesn't mean that other systems which are less fragmented are, immediately superior in every single way to ours. But what that calls for is coordination, collaboration, everybody recognizing the same problems and dealing with them instead of fighting turf battles over what those things look like. And of course, then there's the global perspective, which calls forth those issues as well. So if we're thinking about mergers and we think about the fact that many of these institutions, certainly most of these markets in many respects are global, but our institutions and our regulators are national. I mean, that leads you to thinking about Mervyn King's and others' famous dictum, which is, these institutions are global in life, but national in death, which doesn't help anybody.
Yeah, I just want to underline the important point that Karen made about Title VIII designation sort of flying beneath the radar, but being increasingly important now. I mean, we talk about too big to fail a lot with regards to banks, but the consolidation in the tech industry makes that look like child's play. I mean, it really is a winner-take-all market in the tech industry, and so you're very likely to just have, one or maybe two dominant players. And so I think we do need to start thinking about, and I think people already are starting to think about Title VIII designation for cloud service providers like AWS and Microsoft Azure.
It is payments, after all.
Exactly, and I think it's also, exactly, because I mean, if you store your data on the cloud about what people's balances are, you can't process payments without that. I think also, another candidate for consideration there is Plaid. Plaid basically provides a lot of the APIs that connect different banks to fintechs, et cetera. That flies largely beneath the radar, but it's, again, critical infrastructure, or it is becoming critical infrastructure if it's not already. I personally don't think that there's any business putting financial services on a permissionless blockchain, and I'm happy to elaborate on that in the Q&A if people want me to. But if these kinds of blockchains continue to be incorporated into the traditional financial system, again, that's another candidate for Title VIII designation. So I think that's an area really to watch. Okay, so again, I think this is a really, kind of very interesting kind of issue that is, in some sense, it's specific to this issue of mergers, but in terms of the policy debate, I mean, I guess one quick question for the panel before we move on is, whether we're thinking about banks or non-banks, I think all of you at one point or another, you referenced economies of scale. And it just seems like a fundamental feature of technology in the economy. Not everywhere, but in a variety of contexts. Go to Home Depot someday. It's everywhere. It's hard to escape. And so, like a question from a policy perspective, just very kind of as a brief follow-up to this, which I think about all the time, is this fundamental tension between regulation and the underlying economics. So if the underlying economics are such that economies of scale are present and real, whether that be in banking, whether that be in payments technology, whether that be in asset management services, are we destined to a world where basically for one reason or another, policymakers are basically just destined to put a lid on size and say, look, we know there's money on the table to be had for the economy and for people, but we're just not going to let ourselves have it because of the risks that we see there, and we're going to live with less, and we're just going to, that's the deal for safety and soundness, or is there a way of bridging that gap?
It's not size per se. It's the risk that comes along with it, and the risk that comes with concentration. And so those risks could be, and those are things that we've recognized for some time. We haven't dealt with them adequately. The concentration risk can lead to a variety of other problems. But the substitutability, or lack of it, that may arise with concentration and size are also extremely important. So you had on the panel earlier, a large global provider of custodial services, right? In fact, there are two who account for about half the custodial services in the world. The question is that a good state of affairs? What happens if one of them is crippled through an operational problem? Does that take down the financial system? It's something we need to think about. So size is not a good substitute for risk. We need to think about it from the other end of the telescope in terms of risk and the risks that come along with those other factors.
Yeah, I think I would add, Sean, from an economics perspective, it depends on short, long, and what are you looking at? I mean, the economics of profitability or the economics of macroeconomic or financial stability? If you think about economics from a broader perspective, a long time ago I went to MIT, and one of the fundamental things they teach you as an engineer is redundancy. And yes, it costs more to put two engines on a plane, but you really want to have two engines on a plane. And so we have this natural tension, but between the quarter by quarter, minute by minute, profit, bottom line thinking, and then structural stability. And in engineering, the same thing is true in operational systems, where I think a lot of redundancy has been lost by virtue of got to get there first, and move fast and break things mentality. But you step back and you think about what does it really take, and one of the core principles of engineering that I think directly applies to finance, and not just operational, is redundancy. And it costs more upfront, but it costs a lot less later on.
I couldn't agree more. I think an analogy that really sort of highlights this for people is if we look at what happened to supply chains during the COVID-19 pandemic, we learned that, that making sacrifices to have the most efficient delivery mechanism created fragilities. And that we need to reckon with the same kind of thing in the delivery of financial services and many other areas. Are we in a position where increases in efficiency are only really delivering diminishing marginal returns that are outweighed by the fragilities that they create? And I think redundancy needs to be much more of an area of focus.
Okay, great. So we've talked a little bit about an important regulatory issue with regards to, say, merger policy. So that's kind of in the vein of regulation. And I think speaking for myself, and I think a lot of the people in this room, we spend a lot of time thinking about regulation. But another aspect of sort of oversight that's, of course, very important beyond regulation is this issue of oversight and supervision. I think recent events from the spring of this past year, I think, kind of brought that into stark relief in many ways in the narrow context of the banking industry. But of course, oversight and supervision is clearly relevant in the non-bank financial space as well, Dick. And so, what are your thoughts on sort of where are we with respect to oversight and supervision in the non-bank financial space, and what are your views with respect to kind of where we are and sort of what's the overall degree of feasibility of actually doing it, given the variation, the diversity, and all the challenges that must face?
Yeah, well, as everybody knows in this room, and Karen alluded to it, we have a process for designation of systemically important non-bank financial institutions. We have a separate process for our financial market utilities, and we have a different process which is related to others. And there's been a lot of pushback on that process because, of course, those institutions don't particularly like to be overseen and supervised, and to be subject to, as they frame it, to bank-like regulatory structures. And so I think that the question is, can we have supervision with the undergirding of the typical structure that we have, which laws create authorities for regulators to operate. Those regulations are promulgated in order to give people guidance on what they need to do and what they need to comply with. And then the supervisors ensure compliance and make sure that the regulations are being followed in the spirit of managing risk, in the spirit of adhering to the kinds of goals we have for regulation generally: protect consumers, protect investors, safe and sound institutions, fair and effective markets, and on and on. Safe, financial stability, and of course, preventing financial crime. So do we do that for non-bank financial institutions? Not on your life. And does the designation process help us do that? It's a process. It could if we had the right kind of supervision, but I think we need a big rethink about the way that institutions that aren't banks, but which engage in activities that might cause risks, really are overseen and supervised. Now, there was obviously a big debate that we've had, and it's in Dodd-Frank in Section 120 and in Sections 113, 165, not to cite the law too much. Hillary is a lawyer smiling. But I learned this stuff. And the point is that you have both of those things in Dodd-Frank. And some people would say, well, we need an activities-based framework. Other people would say, no, we need an entities-based framework. And I say, nonsense. We need both, because when we look at entities, we need to think about the activities in which they engage. And, Hillary cited, and I would cite frequently, and I've written about it, if we identify a risk that's similar, we ought to have the same regulatory outcome for managing those risks. That really means that that's a principle. That's not a guidepost for specific regulation. Likewise for technology. We ought to have technology-neutral principles for regulation, for operational risk, but technology-specific tools for the kinds of technologies that we're trying to address. So in this case, we need specific kinds of tools to address the risks that arise, even if they're similar to those in banking and the business of banking, in non-bank financial intermediaries. And I think that's really important. And we have some of those for financial market utilities, For example, stress testing. You know, good practice by risk managers, and I teach this stuff, involves stress testing. Some people do it very frequently, like daily. Some people do it less frequently, where the risks move more slowly. But that's a tool which can be adapted to and used. It can be misused, admittedly, but it can be used to assess risk and to calibrate resilience in institutions and the activities in which they engage. And that's kind of the framing that I think people need to start thinking more about when they think about what supervision and oversight looks like. We wrote a book at Stern after the turmoil, the banking turmoil, and I wrote the chapter on supervision and regulation and resolution. And I think we need to think about how to adapt those tools that are codified in regulation and law that apply to banks. And we need to think about what we need that's missing in the non-bank arena. Because the goals have to be similar to manage the risks, but the tools have to be different.
Got it. Hillary?
I mean, I'll say something that's perhaps a little provocative, which is I think we need to give the regulators some permission to fail sometimes, right? Because we're asking a lot of regulators. We're asking them to move into potentially new spaces, to look at new types of technology, without the resources that the private sector has to develop these resources. And, unless they try and experiment with new forms of stress testing. I mean, there's chaos engineering. There's all kinds of stuff you can play around with. Unless they try and do that, then basically they're ceding. They're giving up. But the challenge is that when you do try new things, you are inevitably going to make mistakes. That's what innovation is in the public sector as well as the private sector. And yet we have a very different attitude to the public sector and its failures than we do for the private sector. And unless we sort of adapt that a little in recognition of the challenges that regulators face and support the regulators in what they're doing, then it's sort of, that's sort of the end of regulation to a certain degree.
So that's a really interesting thought. Just like in the private sector, just like in life, you sort of need to fail so that you can learn from your mistakes and improve. Are there any areas or any jurisdictions or any particular areas of oversight or supervision where you see that happening even a little bit, that you see as sort of signs for hope?
I mean, there are regulatory agencies that have their own sort of internal, they call them all different things, like sandboxes or tech sprints or things like that, and they're trying to bring some of that fail-fast mentality into the regulatory agencies. I think France, for example, has something called Le Lab, but I know. But I think, frankly, the political situation in the United States makes that a lot harder. If you have regulatory agencies who largely have public buy-in and support, that gives them more flexibility, whereas, regulatory agencies here, you don't want to be the next Solyndra, right, and have everything, your failed experiment on the front page of the newspaper, but there will always be failed experiments if you're experimenting at all.
Got it. Karen, any final thoughts on this topic?
Well, I think Hillary and Dick have talked about really important big picture issues, so I'm going to take something down kind of more little and immediate. Last week, FDIC Chairman Marty Gruenberg gave a speech elaborating on comments he's made before, which are fundamentally that if the new in particular capital or the other pending banking rules have adverse effects on the ability of banks to compete with non-bank firms, so be it. Banks need to be really big. If they're really big, they need to be really safe. If activities and even risks migrate outside of the banking system, over to the SOC, the Financial Stability Oversight Council. Well, as Dick said, they have two authorities, activity and practice and SIFI designation. SIFI designation, even after the FSOC finalizes these rules, will be fought tooth and nail, moment by moment. Maybe somebody will get designated by the end of 2024, probably not. So what about activity and practice regulation? Well, in fact, to be really blunt, that's toothless. Because what does Dodd-Frank say? Hillary, I'm going to practice as much law as Dick without a license to do it. What it says is if FSOC sees a significant non-bank activity or practice systemic risk, it should lay out what it would like the primary federal regulator to do. Problem one, as was the case with the Securities and Exchange Commission in 2013, when it didn't like what FSOC said about money market funds, it didn't do it. Problem two is that pretty much all, particularly in the operational risks sectors, going back to the ICE merger, it doesn't have, whether it's ICE for mortgages, whether it's ICE for the New York Stock Exchange, whether it's ICE for CDS, it hasn't a single federal regulator with prudential safety and soundness authority. That's not what the SEC does, not what the CFTC do, that's not what their charters say. And in lots of entities like mortgage, there is no safety and soundness regulation, full stop. At the federal level, if at all, ditto insurance. So to say that we can deal with the risks we knowingly or I think willfully is a better word, create by virtue of big bank regulation in terms of financial system as a whole should be tossed over to FSOC, I think is really a very significant dereliction of long-term public duty. And I think I'd like to see that called out, because it may look like Dodd-Frank gave us an FSOC, but it gave us a very, very limited FSOC, particularly when it comes to risk migration.
Having served on FSOC, I can testify to that.
So Hillary, I actually want to turn to you at this juncture and pick up where Karen left off and talk a little bit about the FSOC. Of course, in the U.S., it's sort of it's I don't know, I wouldn't say it's the only game in town, but it's a very highly publicized game in town, and it was born within the Dodd-Frank Act as a contemplated solution to the problem of the proliferation of non-banks. And of course, recently the U.S. Treasury has put out a proposal to amend its analytic framework for thinking about how it does designations and sort of the guidance around how it would do those designations. And given your background in sort of legal expertise, I would really like to get your thoughts on two related issues. So one, what do you see as kind of, the oops, sorry. That's embarrassing. Okay.
That's the chair of
I get
FSOC.
I get 3 phone calls a month on the phone, and one has to happen today. All right, very good, very good.
It wasn't your mom.
Thank you, and I can attest it wasn't. So my mom would be calling from heaven, but that's okay. That was a long time ago. A long time ago. How do you think about the how do you think about the legal issues facing the development of sort of regulation and guidance around the FSOC, and then just from a substantive perspective, substantively, what promise does that process hold for thinking seriously about sort of comprehensive sort of regulatory oversight for non-banks?
So, a lot of my answer has already been stolen by Dick and Karen, who cited all the relevant sections, et cetera. And then Karen explained how the 120 recommendation power is just that, a recommendation power. And so, people who say we should have an activities-based approach, that's premised on a misunderstanding of what 120 is in the first place. So really, the real power that the FSOC had, the FSOC actually, I think, works quite well as a communication and coordination forum, and so we shouldn't underestimate that. Yep. But in terms of its actual power, I think the designation power is it. And so the Title VIII designation power has gone, largely beneath the radar, not too much attention paid to that. It's the designation of non-bank financial institutions that has caught all the attention and all the litigation and all the back and forth. And so I guess your question is sort of asking, first of all, how valuable is that? Yeah. And I think it's not the whole story, but I think it's definitely an important tool for the FSOC to have, even if it's not used, right? With designation on the table, that potentially acts as a threat that encourages non-bank financial institutions from becoming too systemically important. Now, I'm not sure how we would quantify that threat, how big it is. I don't know if this is going to discourage Facebook from getting into financial services too deep because they fear designation, but it certainly doesn't hurt to have it on the table. And so I'm glad to see the current administration reinvigorating it. I think it also, just as sort of as an expressive matter, I think the 2019 guidance really sort of misunderstood what financial stability regulation is about and communicated misunderstandings in a way that I don't think it was helpful. It sort of suggested that there are certainties in financial stability regulation that are not there. It wanted cost-benefit analysis. It wanted to know if something would cause financial distress, not could it. Those kinds of things misunderstand the fact that, and again, I guess I'm calling for grace for regulators again, but systemic risk regulation and financial stability regulation are messy, and there are no clear answers. But if you don't do it, to go back to Karen's point, that the long-term consequences are catastrophic. So there needs to be a little wiggle room, and I think the revisions that have been proposed recently in April, I think communicate that financial stability regulation requires some discretion.
Dick or Karen, pick up on that?
Well, having been through this process, in the room inside, I would be less charitable than Hillary was about the 2019 guidance. But, hopefully that's behind us. We'll see. It may hinge on the outcome of the election next year. But, basically, I think that what we've got now is a reversion back to something that makes a lot more sense. And I think to what we had then, it also adds a collaborative approach, a communication approach that is a little bit different. Rather than an adversarial, we're going to designate you and we want the following information from you. And we have this interpretive guidance that's going to be used to specify what the criteria are. That's all well and good, but to Hillary's point, some of these things may not be visible to the naked eye, and they may not be measurable and quantifiable to the extent that we would love to have that. And so when we think about risk management, you have to deal with both uncertainty and risk. You can't avoid the uncertainty. You need to live in the real world, which involves that, both of those things. And you need to think about not just what has happened, but you need to think about hypotheticals about what could badly go wrong and what will be the consequences of those things happening. And that's what this really is all about. And so I think that this is a step in the right direction. I would add, just to reinforce what Hillary said about Title VIII, and to even extend it, we ought to think about all the payments mechanisms that we have in our financial system and think about whether or not these new technologies are something that would come under the umbrella of Title VIII. Because I think that is, everyone in this room understands what Title VIII is, and Title VII that has a certain kind of activities associated with that. That can be a useful law that's already on the books that regulators can use to promulgate new rules and supervisors can use to think about what's going on there. There was a Brookings report that came out 2 or 3 years ago that basically said, all of our regulators should have, at least de facto, a financial stability mandate because everything they do involves that. Whether or not that happens or not, at one level they need to collaborate with each other. And that was part of the process, the FSOC process. And when it works, it's pretty good. When it doesn't work and everybody's just, stating their opinion and not listening to what the others have to say, that's problematic. The last thing I'd say, which I think is very important, which we haven't really raised here, because we've been talking about banking and non-banks, all these institutions, all these firms, all these entities transact in financial markets. And what we've seen of late, not just of late, but starting in 2014, we certainly saw it in the Dash for Cash in 2020 at the time of the pandemic, we had market dysfunction that the central banks around the world had to respond to. And we need to think about how to make our markets more resilient, particularly those that are critically important, like the Treasury market. There's a lot of work being done on that, but we need to have a holistic approach to doing that work that focuses on not just the markets themselves and the infrastructure of those markets, which is very important, but also the institutions who engage in those markets. So we think about one aspect of that. We're talking about, through an SEC proposed rule, to have central clearing for treasuries and treasury repo. And that's not a bad idea. It won't solve all the problems that some people think that it will. But before we do that, we need to make sure that the platforms themselves are resilient, that they have good risk management, that we have better governance around those institutions, so that the playing field between the CCPs and their clearing members is more level. And there have been steps taken by CFTC and by the SEC to try to, re-level the playing field in that regard. We need to do more work there.
Okay, thanks. Karen, any final thoughts?
No, I think everything Hillary and Dick have said really say the key points that need to be made.
Okay, great. Look, this has been a really wide-ranging conversation. We've sort of touched on a lot of issues. Of course, by necessity, it has to be because the non-bank arena is itself so wide-ranging. I want to make sure that we spend, at least we provide some time to sort of have some back and forth with the audience in case there are any questions in the time that remains. So I'll see if there's any folks in the audience that have any questions for our panelists or any topic that we didn't discuss that they'd like us to touch upon.
Thanks. One question, following up, Sean, on your question on scale and the risk that comes from it. One of the solutions put out there was addressing the concentration, but what we've seen is kind of a shutdown in the pipeline of institutions being able to grow with some of the caps on mergers and acquisitions. And so then outside, we talked about, right, you don't have a framework for overseeing operational risk for the non-banks. So, like, how do we address this concentration issue if we aren't bringing new, bigger financial institutions into these markets?
Any thoughts?
Well, I think right now the answer is you don't, and that's really the point I think of everything we're saying, is that these are critical challenges in financial policy that are not being well addressed, and all of you here have more than the ability to do that. Hillary and Dick and I have talked a lot about financial market utilities. The last time anyone was designated was 2012, and things have changed. We really need a lot of the tools to address concentration, size, and the other key indicia of financial risk, one of which I think was very well focused on in the new proposed approach to systemic analytics by FSOC, is interconnections. We need to really focus on interconnectivity in the payment, settlement, and clearing space, spaces that the law allows you to define quite broadly, and then look at really who needs to be brought under not only safety and soundness, but really vitally resolvability procedures and protocols. Because I think ultimately, we could regulate all we want, but if an entity is not resolvable, it doesn't matter how much capital they have. It's resolvability issues, particularly in an operational risk context with contingency planning, redundancy. That's really overlooked, and it couldn't be more critical.
I would insert to that not just resolvability, but also recoverability.
Yes, of course, absolutely.
Which comes before, hopefully resolvability is sort of the last link in the chain when everything else has not worked. But recoverability is super important.
And I think implicit in your question is a really challenging problem, which is how do you bring about redundancy when there are network effects that ensure that that basically a single provider is going to exist. And it's funny, like we do hear from the tech industry that they have sort of technological solutions that are going to fix this. We hear a lot about decentralization, et cetera. But that rhetoric around decentralization just doesn't hold, right? You can have technological decentralization. You can have a lot of nodes in a system. But if someone controls all the nodes, then they're going to control the system. So I don't have an answer to your question other than to acknowledge trying to achieve redundancy with infrastructure that displays network effects is really challenging.
Okay, great. And I think there's maybe one other question right there. Ian?
Yeah, would any of you want to take a shot at which firms, or if not, which sectors would most likely get designated if the FSOC eventually goes that route?
I don't want to take a shot at that, but I would just say, look, what the FSOC needs to do, should be doing, is to assess the risk in these institutions. And to the extent that, as I mentioned before, we've got a regulatory system, Karen alluded to the insurance regulatory system, which is, as you know, state-based or territorially based. And the industry loves that because, they can play one off against the other. If anyone from the insurance industry is here, I'm sure you might not like that characterization, but that is what it is. And do those individual state-based regulators have the resources, have the knowledge, not just to make mistakes, but do they have the capacity to oversee this this industry, which is so critically important, particularly when we're thinking about issues like cyber insurance or climate risk or geopolitical risk and other things that people who want to be covered are asking for coverage on. How do those institutions price and underwrite that risk? And these institutions can be massive, can be concentrators of risk. So the question is, do we think about that? Well, look at the track record. Karen mentioned that in 2012 there were institutions designated. All 4 have gone off the off-ramp. They were all insurance companies, right? Some of them went off because of process faults. Some of them went off because the process was not good enough to prove that they should have been designated. So this new process hopefully will have a way to overcome that by thinking about where is the risk, who's going to be affected by it. Insurance companies can't be considered independent of the rest of the financial system because on both sides of the balance sheet, they're interconnected. And that's how we need to think about this.
So I guess I would say that we've been talking a lot about technology, et cetera, today, and new types of systemic risks, et cetera. That conversation is important, but it can also distract from the fact that the real systemic threats, the biggest ones, are probably good old-fashioned leverage, right? So as the FSOC is looking at potential new candidates for designation, I wouldn't be surprised if it looked at the most leveraged sectors, although I do not like to make predictions.
Well, I know when FSOC released the analytical and the designation indicator, they indicated that their initial targets were, quote, hedge funds and non-bank banks. And in both cases, that would seem to imply a activity or practice approach, because I think it would be really challenging in both of those sectors, maybe, because Hillary's point here about leverage is critical, maybe in the hedge funds, but I think really I don't know that they know. In terms of, I agree absolutely with what you said, Dick, about insurance. I would also point to asset management, not in the way that traditionally, because you have had Fidelity, for example, Federated rather, fighting infidelity, but Federated in particular fighting hard at every venue to prevent designation. But what about BlackRock? What are the risks embedded in I keep losing track. I think, Joe, Barry, you could connect me. What are they, $11 trillion of assets under management right now? And I know they say all the risk is with the investors. We never take any risk. Well, that's just palpably not true. That was what money market funds said in 2020. They do a lot of things to prevent risk from channeling through to investors, particularly in a company like BlackRock, where if it did, really bad things would happen. But we don't have a framework yet for thinking about what are the risks when assets are under management. It's much easier to poke fingers in the eyes of the big banks where the assets are on the balance sheet.
Okay. Let me make one last point if I could. And that is, in order to make good decisions, we need good information, good data. One of the things that I tried to do when I was here for 6.5 years was to improve the quality, scope, and fit for purpose nature of our financial data, to shine a light on where the risks were, particularly those that were in the shadows. And we have a lot of non-transparent financial activity. Karen alluded to private credit. I don't know about 40 trillion, that space, private credit is only $1 trillion now, so 40 trillion by 2030 is a lot of growth. That's right. But it just seems to me that all these players need to have better access to data. And to be honest, it seems to me that the industry itself should be signing up for that, should be signing up for the risk management need for better information, better data. Because it's not enough as a risk manager to think about what's going on in the four walls of your institution. You need to think about what's going on outside and how it can kill you.
Okay, great. Well, look, this has been a really great discussion. I've learned a lot from the conversation this afternoon, so thank all of you very much for participating today. And please help join me thank my panelists for the conversation today. Thank you.